Yesterday's gains boosted gold's quarter-to-date advance over 16%, the highest quarterly gain since 1986.
Welcome to this morning's Markets and Metals with Vince Lanci, where each morning he brings you the precious metals news to get you ready for your day. Now, here's Vince.
Good morning, everyone. I'm Vince Lanci. It's Friday. It's 8:26. So we'll be live when the data comes out today. Late start today. Those of you who are on X probably know why. Okay. The last time gold did this, pithy little headline I kind of stole from Zero Hedge. We'll get into that in a second. We're also going to talk about, well, the problem that the Atlanta Fed has with categorizing gold as money or not as money, or what do we call it? And the horns of the dilemma that the Western neo-Keynesian world is on now. All right, so let's start with the markets. 4 minutes into it, you'll probably see a reaction. We'll talk about that on the back end. 10-year yields are down 3 at 433. The dollar is 104.45, up 17. The S&P 500 is 56.82 and change, down 10. The VIX is 19.10, up 42. Gold is 30.75, up 19, pretty much on its highs. Silver 34.51, up 13. Actually was down in the first leg of this move higher in gold overnight. Copper is 508, up a penny. WTI 70.29, up 13. This is a problem. Natural gas 390, unchanged. Bitcoin 85 and change, down almost 2,000. Palladium 985, up 9. Platinum 985, down less than 1. Gold, silver 89. Soybean 1004. Corn 437. Wheat 531-ish, down 2 and change, down 4 and change, down 8 and change. Grains are all down. Okay. Homepage. We put out a lot of content yesterday, and that's because, well, we had to. I mean, there were some really good reports that were out there, implications of which we'll go over this weekend. We're going to do some HeartNet style walkthroughs for these reports, simply because any report that comes out from a bank after them is going to be hard to beat these for covering, divulging what we've all suspected. Whether it becomes the top of the market or not, that remains to be seen. It's 8:28 right now. All right. And here's yesterday's stories to that effect. Goldman, 4,500 upside scenario, base targets 33 to 3,500. It could be a bear trap. That's for founders. Bank of America report gold plating, guns and cannons. Founders, Goldman sees 4,500 tail risk in 2025, raises all targets. And Goldfix PM, lots to digest there. Analysis. The last time gold did this, it's 8:29. Yesterday's gains boosted gold's quarter-to-date advance over 16%, the highest quarterly gain since 1986. Most past precedents are concentrated in the 1970s and 80s, a protracted stagflationary period marked by multiple economic recessions and very high inflation. So macroeconomic people look at these, and I'm one of those. So first of all, it's a Bloomberg graphic. So of course, gold's rally looks overdone. They're not going to retire from hating gold all at once. You have a list of the past times when the bullion gained at least 15, 16% in a quarter. So it's 1986, 1982, 1980, 1979, 1979, 1978, yada, yada. You could see the pattern. And the pattern is stagflation is the environment. Inflation, but more appropriately, stagflation was the environment that contributed to these type of gains. And then the next quarter, they show that the market is on average probably slightly higher, but volatilely mixed. And they really show the the lack of correlation with CPI. But this time is different. All right, so data is out. You can watch the screen while I'm doing this. it appears, I'm paraphrasing, or maybe I'm quoting Zero Hedge here. It appears the market is pricing in another such period. And that's what tariffs do. Slow down in the economy, an increase in inflation. And that's pretty bearish for the economy. That's a back to the 70s sort of thing. Auto tariffs are related to that too. Anyway, no rabbit holes today. Moving on. The Fed's treatment of gold. We say that all gold is monetary gold. That labeling gold as a non-monetary gold just because it's in a 24-karat ring is silly. That's the accounting trick that the government's been using to manipulate market structure to reflect gold as something that's just not something you want to own. At the correct temperature, all gold is monetary gold. Why are we bringing that up? Well, the Atlanta Fed has kind of said the quiet thing out loud, showing a chart similar to what JP Morgan did. Also, they did it quietly, but they did it. Similar to what Goldman Sachs did, a little bit less quietly. They are now showing the path for GDP with and without gold purchases. Let me read this and then I'll give a little background. The Atlanta Fed says the GDP Now model estimates for real GDP growth, seasonally adjusted annual rate in the first quarter of 2025 is minus 1.8% on March 26th, unchanged from March 18th after rounding. After recent releases from the U.S. Census Bureau and the National Association of Realtors, the nowcast of first quarter real gross private domestic investment growth decreased from 9.1% to 8.8%. The alternative model forecast, which adjusts for imports and exports of gold, is 0.2%. The alternative model versus the current model. The current model that's been in place forever says the following. Gold is not an economic asset. It just sits there. It does nothing. And as such, we don't count it towards GDP. And so if you buy gold, which does nothing for the economy, you drop GDP. And so if you're trying to work with the books, if you're goal seeking to get good GDP, you sell gold. That's why the government's been selling gold or letting someone else sell the gold for decades. Okay, but now on the scene is the alternative model forecast, which adjusts for imports and exports of gold, and it says 0.2%. So what are they doing here? The horns of the dilemma that I'm talking about here is the Atlanta Fed is putting back in the economic effect of gold as an alternative. Whatever the data is, gold likes it, silver likes it, stocks don't like it. Sounds like stagflation to me. Oil is a little bit unchanged, more like unchanged. All right. So the Atlanta Fed showing you an alternative model forecast is a contradiction of decades of economic data dogma. No one is asking why this change in status is happening. Why would we do that? No one is asking why all this gold is being delivered, most obviously, right? And why would you readjust if gold is a pet rock? Well, you could look at it as undoing gaslighting or reverse gaslighting. So we believe, here, I'll put this chart up so you get an idea. The steeper line, which is the line that neo-Keynesians and our economists have been subscribing to since 1971, is that gold is not an economic asset. So we're buying all this gold and we're actually spending money on something that doesn't give us any economic return. You can see when you look at that data and you're an economist, you see that, oh, well, then I should never buy gold. And that's what's been happening in this economy forever. But now we're still buying the gold. Why are we buying the gold? Why are we bringing the gold over here? Repatriating the gold, whatever. We're buying gold too. Why would we do that? Why would we sabotage our own economic theories? Well, that's the point. We believe the U.S. economic runway is being smoothed paved for something bigger. Whether it's monetization through an asset-backed bond or an instrument tied to a sovereign wealth fund, as Percent probably in error mentioned, we don't know. It could be related to the Stablecoin Act, which is the US using stable coins to harness and protect the dollar. You would use gold in that as well. Or perhaps it's deadline related. Bullion banks may need to prepare their books for a July 1st Basel III true up. Personally, I hope it's to refill Fort Knox, currently home to little more than moths and half-eaten IUs, as we introduced conceptually about a month and a half ago. But then again, we don't know. Maybe that's completely off base, right? It doesn't have to be a change. It doesn't have to be a ramping. It doesn't have to be a paving of the runway. Maybe it's simply a precautionary move, a hedge, a smart move in case a foreign country tries to weaponize gold in response to our tariffs. For example, April 2nd, our tariffs go into effect. March 31st, China ramps up their gold buying for insurance companies. These things are two opposite sides of the same coin. Either way, whether I'm right and we're making way for a change, or we're just hedging risk, the US, through various proxies, is not only buying gold, it's going out of its way to ignore that it's doing so publicly. To such an extent, in fact, that it now faces a choice: either declare a recession, according to the Atlanta Fed, or recategorize gold as an economic good. Now, that would mean shifting gold status from pet rock to a recognized measure of national wealth. So here's the dilemma neo-Keynesian economists have created. Either gold is counted economically, undoing decades of narrative management. Narrative management is a nice way of saying gaslighting. Or, per the Atlanta Fed's own models, we're in a recession headed towards a depression if you go with that slope. That's why we believe the economic runway is actually being paved one way or another for rebalancing of what is and what is not good for our economy. And though it may be a dagger in the hearts of frozen dairy purveyors everywhere, gold is becoming a central component of the economy in this new, less global, more mercantilist world. As the philosopher, we're on $23 now, as the philosopher once said, we got to make the best of it. Improvise, adapt to the environment. Darwin, shit happens, I Ching, whatever, man. We got to roll with it. I would suggest that neo-Keynesians start to roll with it. Make your way, because change is here. Okay, so we're going to go to the charts now. Actually, we'll do the markets recap. Yesterday, stocks ended lower while benchmark treasury yields rose as investors assess the economic impact of Donald Trump's auto tariffs. Wow, we really are stagflationary, aren't we? The dollar weakened as uncertainties loom about reciprocal tariffs. In commodities, oil prices inched up amid supply and trade war concern, while gold scaled a record peak on safe haven demand. Quick comment, phrasing. The dollar weakened as uncertainties loom about reciprocal tariffs. How about this? The dollar weakened because tariffs are bearish for the dollars in the long run, because people hold less dollars. But that's how the media works. Okay, market news. You can take a look at that. I'll pull the charts up in a second. Okay, so there's the charts. I had something I had prepared yesterday, but it's really convoluted, and it's the third level thinking stuff, which kind of gets lost in the weeds. But I'm going to show you a chart of it anyway, just to give you a visual. It's actually, I think it's stunning visually. Many times during those HeartNet conversations, I will say things like, if you're long gold, you're long emerging markets. Meaning, in the eyes of the Fed, or in the eyes of economists that run the Fed, gold is like an emerging market country. Think of gold as a nation. So when the dollar does weaker, emerging market currencies go up, gold goes up. When the dollar does weaker, emerging market economies do better. So if, and by the way, emerging market economies have a lot of gold, right? So if you strengthen the dollar against emerging market currencies, you weaken their currency and the assets that make up their economy. Okay. So being long gold is being long an emerging market. That's the background. Gold has gone up, but emerging market currencies have not. That's right, but they own it. So let's take a look at the dollar versus the rest of the G7 versus the dollar versus emerging market currencies. This is the DXY. It's the dollar versus basically the G7. It's mostly euro, yen, and a couple other currencies in there. Maybe the yuan is in there, but essentially it's the dollar versus its G7 partners for the most part. You can see what's happened there. It's going back to, I think, July of 2020. Oh, I cut my dates off. Hold on. There you go. All right, so you have the dollar, the DXY versus G7 countries. Now let's put up the dollar versus the BRICS, not just the BRICS, but people and other nations that behave like the BRICS. This is essentially the dollar versus the euro and the yen. Now let's put the dollar versus emerging markets or BRICS. You can see that the dollar is doing better against the euro, against the yen, but it's doing much better against emerging markets. Now, in the past, I don't have the data showing here going back. I haven't prepared it properly. But before COVID, when the emerging markets dropped, gold dropped, right? So when the dollar was strong, gold dropped because gold's correlated with the dollar. Well, gold's positively correlated with emerging markets. So when you strengthen the dollar, whether you do it intentionally or just a byproduct of economics, you hurt emerging markets in multiple ways. You hurt them at the currency level, which hurts their economy. Then you also weaken the price of their economic asset. So going back forever, when the dollar went up, what did gold do? Gold went down. When the dollar went up, emerging market currencies went down. Let's look at the dollar versus gold and emerging markets. This is crazy. There you go. Same chart, scale changed, showing the dollar overlaid. You still have the blue line. I should have picked different colors. The blue line is the dollar is doing better than emerging market currencies, right? But now you have gold exploding in percentage terms. Now, this isn't a true up of a GDP compensation. But it'll give you an idea that if you're an emerging market forever, when the dollar went up, gold went down, and your currency went down, and the cost of your debt went up. You had to get more dollars, right? And gold never did what it was supposed to do in your own currency. I mean, in the dollar. It did it in your own currency, but not against the dollar. And then after COVID, that changed. And then further after COVID, after the Ukraine-Russian war started, the whole picture changed. So I would put it to you this way. What's going on now will not stop. If you're an emerging market, if you're let's pick a small country. Let's pick a country like Armenia, right? I wouldn't call them emerging, but they're a BRICS country, right? Okay. And your currencies, and you borrow money from in US dollars, and your currency's constantly getting hammered when the dollar rallies. And the gold that you own, they buy a lot of gold, is constantly getting hammered because it's denominated in dollars. And you see this and you go, oh, my gold's doing its job now. It's a hedge against my dollar risk. Are you going to sell it out and buy dollars? No, you're going to buy more. The BRICS are going to keep buying gold because gold keeps doing what it's supposed to do, and that is hedging their economic risk tied to the dollar. The question I'll leave you with before we go is, why is this happening? We know why it's happening. The world doesn't trust the US, right? And that's true. That's true. mercantilism, a protectionist environment, a deglobalization, a renewal of the Berlin Wall, what have you. But just go even further out. Do you think the US would let that happen if they could stop it? No. I believe that the US is working on this with these countries to facilitate a changeover to a new monetary system. Whether that be a gold standard or not is really irrelevant. They're going to be using gold for international trade, and this is the way they're going to get it up to a point where every trade partner is happy and they can compete fairly with each other. Again, I'm Vince. Have a great day.
Well, thank you to Vince, and thank you all for watching at home. Sure hope you enjoyed that and that you've been enjoying the new world where we've seen gold trade over $3,000 per ounce. And especially with everything that's happening, if you've been looking for an additional way, especially when you're busy, to stay up to date on the main themes going on in the gold and silver markets, well, would like to let you know that we have the Arcadia Economics Gold and Silver Daily, where we provide a written column recapping the main themes of what's going on. And really what we aimed for here was to make this so that it's easy and fun to read. It's not super technical, but if you want to stay up to date on the things that are happening in the markets on a daily basis, especially as the gold price has just crossed over $3,000 an ounce, while issues in the silver supply remain unresolved. And there's still questions about why so much gold had to leave London when there were never any tariffs on London. And those are the kind of things we dig into each day, along with Fort Knox audits, tariffs, and we mix in some video as well in there and keep it nice and short so you can get through it and stay up to date on the things that are going on. So just click on the link on our Substack to go to the Arcadia Economics Gold and Silver Daily. And I hope you enjoyed that. Look forward to seeing you again soon. Please note that this video is not intended as legal licensed financial trading advice and is to be used for informational purposes only. Please contact your financial advisor before making any decisions, and thanks for watching.